Hello Sector Watchers, welcome to the show. This is the 57th episode of Sector Spotlight on Tuesday the 24th of November, recorded on the 23rd. My name is Julius de Kempenaer and I'm your host for today's show, as usual. I love to hear your thoughts and ideas. My contact details are on the slide and I love the interaction. It keeps me on track and often gives me ideas for future shows or blog articles. Also, the comment section on every video or article is a good place to communicate. Today, I'll walk you through the current state of sector and asset class rotations. And after the break, we'll take a closer look at cap-weighted sectors versus equal-weight sectors and see how differences between rotational patterns can alert us to potential opportunities or maybe threats. It depends a little bit on how you look at things. Let me start walking you through what happened last week in price and rotation terms. Starting with the asset classes on the left-hand side of the screen, we see an interesting week for commodities with the GSG ETF, the GSCI Commodity Fund, up 2.5%. That's the one right here, just crossing over into the leading quadrant on a daily RRG. So that's good, that's still going strong. And it is followed by DJP, which is the Commodity Index Total Return, the Bloomberg Commodity Index Total Return ETF. GSG has a lot more energy in it, that's why it's going a lot faster, but DJP is rolling back and starting to head in the right direction now, but it's clearly lagging GSG. If we work our way further down the table, we see investment grade corporate bonds having a pretty good week with 1.3%. They are positioned inside the lagging quadrant. We see high yield picking up a little bit. We see government bonds slightly higher. They started the week continuing their relative downtrend, and that's still intact, but the momentum has leveled off and start to pick up a little bit. But even on the daily RRG, government bonds, GOVT, still way to the left. And if we want to compare that with stocks, that's ITOT, which is still far to the right. And again, also here, a pretty good start of the week and then starting to roll over. Relatively short tails on both GOVT and ITOT. So for me, at this stage, these are still hiccups, temporary setbacks with government stocks still to the right, which is positive, and government bonds still to the left, which is negative, relative downtrend. US dollar picking up a little bit, and then a weak week for real estate with a loss of 90 basis points. But look at the tail here. So this is a good example why something that is inside leading not necessarily always has to outperform the benchmark. And what we see here is clearly a delay from the strong move that V&Q had in the previous week. I loaded up the chart here to show you that. This is a daily chart, so here's that run up, and that's following this deterioration in relative strength is picking up. You see that the RRG lines have picked up that improvement, and if we would really zoom in this last bit, you see that relative strength is still increasing. That's why it's moving higher on the horizontal axis, but momentum is almost flat. So that's the reason why. So it had strong momentum, and that's still a delayed effect and offset, which is pulling V&Q further to the right now. If we look at the sector universe, US sector universe here on the right hand side, we see three very interesting tails. That's energy, which is shooting off to the right deeper into the leading quadrant, which is financials, which has really picked up, and which is industrials, which is continuing to do well. We've called industrials a few times in the show previously. So these three had really good weeks. Energy up 5.7, industrials up 1.0%, and then financials up 0.6%. So all three outperforming the benchmark. The other one that was pretty good week was 1.1%. That was materials, and as you can see, compare that tail with the other tails there. Much shorter tail, almost no momentum, but a strong relative trend because it's above 100 on the RS ratio scale. So keep on trucking with materials. Then we have XLRE inside the leading quadrant. It was underperforming S&P with 1.5%. Again, if you look carefully, you can see that that's the difference between comparing with a stock bond benchmark, which was up 0.3%. In that respect, V&Q underperformed. It was still strong tail, but it was underperforming. And if you look at XLRE versus the S&P 500, S&P 500 was down 0.80%, and XLRE underperformed that by 1.5%, or was lower 1.5, so it underperformed the minus 0.8. Sorry about that. If we quickly go through the list, we had energy, we had materials, we had industrials, financials. Then we have discretionary, short tail, still on the left, outperformed benchmark slightly. We had communication services on the daily, rotating into the lagging quadrant, minus 40 basis points. We have a continued weakness in technology, and look at that tail because it rotated around. It started to head up, and then last week it started to rotate back into the lagging quadrant. And then here we have XLRE. We've discussed that. We see consumer staples picking up slightly. That's interesting, but we're going to look at that in relation with the weekly chart later on. We have healthcare, and that continues to surprise me in the situation that we're in. The pandemic, all the healthcare companies, everybody racing for vaccines. A few pops in the healthcare sector of companies that are allegedly producing very effective vaccines. And then you see the healthcare sector actually underperforming, and not a little bit. It's down minus 3%, which is 2.2% under the S&P 500. So although there are some healthcare companies potentially doing very well, the sector as such is not. So to me, the translation that I make in my head is that in the healthcare sector, it's probably very important to be very picky with the names that you buy or want to buy, because the sector as such is clearly underperforming the S&P 500 on this daily RRG. And then finally, we have utilities inside lagging. Start of the week was weak, and then it started to pick up a little bit. So that was the overview quickly for the various sectors. Let's bring in the weekly charts, and I've got a sector spotlight chart here, and here is the ITOT. I'm quickly going to go back and we'll switch this one to a weekly chart so we have everything in perspective. And where is the ITOT? So here's ITOT, still on the right hand side, outperformance for stocks, and you can even see that it is now starting to curl back up inside that weakening quadrant, and that's what you see happening here. And it's now really trying to push above that horizontal resistance in relative strength, and it's outside of this consolidation range. So stocks in general are actually doing pretty well. If we bring that into perspective with the S&P 500, we discussed that before. You can see the break in the S&P 500. That is a positive thing, but what is not so positive or less positive than ITOT is that S&P has not managed to break above its relative highs. So this is the whole story that I wrote about a few times in the past with large cap growth, large cap stocks underperforming at the benefit of small caps and mid caps, and especially the small and mid cap growth stocks. And that's what you see here in this SPY chart, and ITOT curling back up. If we go to GOVT quickly for the asset classes, and and we bring in the GOVT chart, then we see that it bounced off this support level that we mentioned. We see the rolling over inside improving, so which is a negative. It looks as if GOVT is going to go back to the lagging quadrant, and we see the opposite of ITOT, where GOVT is now, well, trying or on the verge of breaking to new relative lows. And I still think that that will get an acceleration when we break below 2740 on GOVT, which would complete that consolidation. If it happens soon, it could be a double top, otherwise it becomes a consolidation. But nevertheless, a break below 2740 will no doubtly accelerate the decline in relative strength. If we switch over to the weekly charts for the S&P 500 and we go to materials, let me see if we can do all of them quite rapidly. We have materials still on the right hand side. That is not my right chart. I need sector spotlight, and I need materials. Here we are. So this trend obviously very clear, and it's getting stronger and stronger as long as it holds up above that relative resistance, which is now acting as support. The setback in momentum is clear. That's following that break, and that leveling off is now picking up. I expect that to translate into rising RS momentum and RS ratio lines anytime soon, and then continue that outperformance in relative strength for materials. If we do the communication services, then that is pushing against its resistance level, and it's doing the same with the with resistance in the relative strength line, and that's why these lines are very close to the zero line. Very short tail, almost nothing happening, more or less in line with the S&P 500. Now energy still far away to the left, but absolutely strong performance in the near term, and we saw that on the daily RRG. You see it on the weekly as well, but there is also still a lot of overhead resistance. For first level that I'm watching is around $40 US, and if you look at that relative line, we're still facing resistance coming off that previous low, and if that causes a turn, then we could be in for another, weak period for energy. Short term, definitely positive. If we can break above 40, everything is cool. Then we have a trend reversal on the weekly chart, and that will very likely also cause a turn on the relative strength line. I think this is more of a short-term play now, because the longer-term picture is still not super convincing, not even with that. These swings are great. Big. They're great, but they're also big. And I don't really see that translated into strong relative strength yet. Another where it is getting stronger is financials. You see XLF inside improving, moving towards the right. And if we bring that onto a regular chart, you see that that is slowly continued to improve. We saw that break here, even above that previous high, 2640, holding up very well. We're pushing against that resistance area between 27, well, let's say 28. Relative strength continues to improve, so it looks as if we got a serious turnaround at hand here for the financial sector. This could be a sector that is becoming more and more interesting. Industrials, as we said, continuing to do well. Short setback, but in terms of price, still very strong, holding up above the breakout level, and relative strength bouncing off its short-term support line, going higher. This little loss of momentum was caused by that sideways move after the break, but that seems to be gone now, and the way is free for both price and relative momentum to pick up and keep industrials at the right-hand side of the graph. It is, by the way, the strongest sector in the US based on the RS ratio. Technology inside weakening, leveled off slightly, but still at a negative trajectory on the RRG. Failure to move beyond 125. Relative strength continues to lose strength, and you see that translated into weaker RRG lines. So for the time being, technology is out of favor. And then we have staples. I said we're going to come back, and here you see that what I meant is that turnaround inside the improving quadrant for the staples sector, and that's also here. Dropping back, it tried to break, didn't really work. Dropping back now, that's usually not a very good sign. And you see that relative strength is now again hovering above that short-term support level. If that breaks, especially if price will continue to drop back into that range, we could get a very weak stint for consumer staples. It looks as if we're gonna put in a new high in RS ratio below the 100 line, and that's a situation that you really don't want to see. That's usually not a very good sign. Real estate pretty quick, then we see that rolling over inside the improving quadrant. If we look at the price chart here, failing to really break out of that range, continuing its downtrend in the relative strength line, and again, just like staples, it looks as if we're ready to put in a high below 100 on the RS ratio line, usually not very strong, and expect real estate to rotate back into lagging. If we go to utilities, then we had a very strong rotation for a few weeks, but that seems to be running out of steam now. We're probably going to go into the leading quadrant, but not at the desired heading, and you see that rally peaked against the target line out of that triangle situation. We tried to get back into the range in terms of relative strength. That didn't work. Going to go back lower, and this sector is definitely at risk for putting in a new peak here in the RS ratio line. Whether that's going to be above or below or right at the 100 line, I can't really tell yet, but from a relative perspective, it looks as if it's running out of steam, and if it's going into leading, it'll only be for a very short period of time, most likely. Here's the healthcare sector. As we discussed, you would expect more from it, but that's not happening, and we see that here, that break is not holding up. Market is maybe not convinced, I don't know, but this old resistance level should have acted as support. That didn't work, so we're now back in that range. Very often, I told you before, that leads to a test of the lower boundary of that range, and you see the new deterioration in the relative strength line where we took out a previous low. We're now resting at this long-term support line, and it's very well possible that XLV is going to put in a new high in RS ratio below 100, causing the tail here to turn around, insight improving back to lagging. And then we'll finish it off with the discretionary sector, which is still at the right-hand side of the RRG chart, which is good. And if we look at the chart here, it lost relative strength. That is very clearly visible. This steep trend line was broken, but we're well above the breakout level that we saw earlier the year. And with the position of XLY on the tail, with the position of the tail of XLY on the graph, which is still far to the right, there is every possibility for consumer discretionary to curl back up inside weakening and move back up towards leading. And the price chart gives us that ability because it's not much, but it is still holding up above that breakout level for the time being. So discretionary is still kind of okay. I want to leave it at this for the walkthrough of asset classes and sectors. We are going for a quick break, and we'll be right back after that with a look at the equal weight sectors versus the sectors that we just saw. So stay tuned. We'll be back in 30 seconds. And welcome back. In the second part of the show, I want to stick with the sectors, but now I would like to take you through the differences and similarities between equal weight and cap-weighted sectors. So on the left-hand side, you see the RRG as we know it with the cap-weighted sectors, the Spider series. And on the right-hand side, we see the Invesco equal weight sector ETFs. And let's quickly walk through the differences, because in general, you would expect the ETF for, say, materials on cap-weighted and equal weight to show a similar type of rotation. I think that comparing those two and keeping an eye on those two RRGs can help us spot differences. And let me put it like this: where the differences are, that's where you get a signal, or that's where you get a message. That's where the graph is telling you a message. Now here I've listed them in alphabetical order on the symbol, so I can, because the names are not actually exactly the same. So if I look at materials here, then I need to find materials in the, there you go, that's already taking me time. So here, so cap weighted, equal weight, similar type of rotation, no problem in my analysis. Communication services, cap weighted, curling up, equal weight, moving further into lagging with a little bit longer tail. Not a massive difference, but very subtly, this tells me that the large caps inside communication services are doing better than the mid-small caps. Obviously, in XLC, that's Google, and Google's doing pretty good on the RRG. So that's the type of differences that I'm looking for to see if these charts can send me any clues. And look for energy, then you see that they are both in the lagging quadrant picking up. That's fine. If we look at financials, then we see a similar type of movement, but I'd say that the equal weight version, RYF, is slightly better. The tail is a little bit longer, but I like the angle a little bit better. So the smaller sizes seem to be outperforming the larger sizes, but not by much. If we look at industrials, where are they here? Equal weight already inside weakening, cap weighted inside leading still. So the larger industrials are better than the smaller industrials. Again, not by much, not a massive difference. Maybe equal weight is leading cap weight, we'll see. But for the time being, the cap weighted, the larger ones, are driving this sector, and they're still doing well. I'm going to skip technology for now, and you'll find out later why. So let's go to staples, consumer staples. Cap weight rolling over, equal weight has already done that. Short tail. So the larger staple stocks have driven the sector higher, but they're now also rolling over, and they're going in the same direction. Real estate, where is my real estate? Here. Large cap weighted rolling over, equal weight still pushing to the right. So also here, the large caps are underperforming. They're doing worse because they're already rolling over. Equal weight is still moving to the right. Looking at this, looks like a matter of time before this one pulls over as well. Look at utilities. You see a similar type of rolling over. You know, utilities leading slightly, but not by much. The pattern is the same. If we go to healthcare, we see the large caps doing slightly better. They pushed ahead higher. the small, they're still all S&P 500, so it's not really small cap, but you know what I mean. The mega caps, the larger names inside the S&P are doing better than the smaller caps, but they're both starting to roll over. If you look at discretionary, it's inside weakening on both sides. The tail is a little bit longer, so the equal weight is a little bit more power, but the difference is not super big, so to say. Here you see that XLY is slightly at 102.5. This one is slightly higher, so the effect of Amazon weakening relatively is more visible here. But the real difference, and that's the reason why I actually picked this subject for the second half, is what we see in technology. If you look at technology on the cap weighted, and let me put it here on the center and blow it up a little bit, and do the same for the equal weight and blow this one up. If you would take away the ticker symbol from those tails and you're looking at RRGs, I think that everybody by now would say, hey, I need this one and I don't want this one. Clearly, this is XLK cap weighted. This is technology, RYT, equal weight. So XLK is being driven down by mega cap names. We all know which they are. But here you see it in action. You see the difference between XLK and RYT in action, and it's clearly in favor of RYT. The reason I saw that is because I wrote an article for the Chart Watchers newsletter diving into this relationship and picking up on those differences. And it reminded me of an article that I wrote a while ago, actually in August, talking about the big risk of Apple inside technology, and I suggested moving out of XLK to RYT to take away that risk for mega cap names like Apple. And if I look at the relationship of RYT and XLK as we are right now, then I think that we're actually still at a pretty good place. If you look at the differences, you see that RYT is breaking out where XLK has not been able to do that, and you see that the relative strength of RYT is breaking to new highs, while the relative strength of XLK is actually rolling over and moving lower. So for now, I think that relationship is still very much in favor of RYT, and it looks as if that has only just started to materialize. So I think that although it's been doing pretty well since August, that relationship continues to move in favor of RYT over XLK. Ladies and gentlemen, this was Sector Spotlight for today. Thank you for watching. If you liked the video, please let us know by clicking the thumbs up icon. If you have any questions or remarks, please use the comment section below, where you will also find my responses. So don't be shy, I won't bite, and I do respond myself. If you prefer to respond privately, my mailbox is open. Rest assured that I do read my mail and I will answer, although it may not be the next day. Sector Spotlight airs every Tuesday from 10:30 to 11 AM Eastern, with replays on the StockCharts YouTube channel. For now, please stay safe, and I hope to see you again next week for a new episode of Sector Spotlight.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.